Hi, my name is Roger Schluter. Today's video is what is an SBA cap line, and I'm sure a lot of you probably haven't heard of the cap line. I mean, I didn't know about it till I'd been lending for a while, and I'm not sure if it's been around that long. But anyway, they want to help small businesses by providing short-term and some for short-term needs and cyclical working capital needs. Basically, the program has four different lines of credit, so it gets kind of complicated. But anyway, those four lines of credit are seasonal cap line, a seasonal increase. It's used for seasonal increases in accounts receivable, inventory, and labor costs. And basically, to give you an example, it might be used on, like, let's say probably the perfect example for a seasonal would either be some type of Christmas business where their business goes way up, November, December, maybe even January, and then dies off. The other one would be like a lawn care, where it's really really busy. Lawn care, landscaping, where it's really busy, like for the spring and summer and fall. But then in the winter, they really don't have any business. So anyway, it's for that seasonal increase. So the number 2 is for a contract cap line. And the contract cap line is for labor and materials, costs associated like with performing assignable contracts. And by assignable is that the SBA and the bank are going to want to assign that contract to that loan. So if you didn't perform, they could find somebody else to perform it and get the money for that contract. The builder's cap line. Builder's cap line is for labor and material costs to contractors when they're constructing or renovating commercial or residential buildings. The maximum maturity on all the cap lines is 10 years, except for the builder's cap line. And that maturity is 5 years. Like I said before, the purpose of the cap line is to finance short-term and cyclical assets. Cap lines cannot be used for change of ownership. So anyway, the number 1, the seasonal cap lines. Eligibility, been in business 12 months or longer, and be able to show a pattern of seasonal activity. The seasonal increase in, eligible use is seasonal increase in accounts receivable, inventory, and labor. The funds may not be used for existing debt. It cannot be used for maintaining activity in slow periods. For an example of that, lawn care, if he wanted to keep his people, paid, I guess, during the winter, it's not for that. It's for those increases in sales, where maybe people aren't paying you right away. They'll be paying you in 30 or 60 days. So usually when you have those big spikes like that, unless the people are paying you cash when you finish the job, that's the optimum. Everybody'd love that. But a lot of times they don't. They said, we'll pay you in 30 days, we'll pay you in 60 days when we do our bills. So then, you're out of that money for that period. So the cap line would be used for that. And usually when businesses are growing, when their sales are going up, if they do have companies that want to pay them later, that there really becomes these huge gaps in cash. And that's what this is for, this seasonal cap line. The number 2 is the contract cap line. And the eligibility, you have to demonstrate an ability to operate profitably on completion of similar contracts. So hopefully you've done a couple of contracts that you could show them that, hey, I've done this contract, I've fulfilled it and finished it and got paid for it. You also have to have an ability to bid costs and perform work, of course. But that bidding, they want you to be able to bid if you're doing a contract. And they want you to have the financial capacity and technical expertise, really to complete the project on time and with profit. So really, hopefully you have something to show that, to show that to SBA. Eligible uses would basically, for the contract, would be the cost of specific contracts and expenses. things allocated to such contracts, expenses allocated to such contracts. It can be used for multiple contracts. So if you're getting multiple contracts, and you can use that same line for that. The things you cannot use it for: you cannot use it for permanent working capital. You cannot use it for fixed assets. Cannot use it for delinquent taxes or existing debt to buy that down. And for contracts that are already in the process, you can't really use it for that. These are for new contracts. You cannot use it for change of ownership. You cannot use it for a floor plan, which floor plans are like, the best example is an auto dealer that has cars out there, and they don't pay down the line until they sell a car, and then they pay it down a certain percentage. Or company markup, you cannot use it for that. The third one would be the builder's cap line. And there's not that many projects for contractors. And you can be really a small contractor too. The eligibility is, of course, you do have to be a contractor. You have to be able to manage that job with at least one managerial or supervisory person that's on the job, and on the job the whole time. And then the cost of the renovation has to be 1/3 or more of the cost of the building. So anyway, and that's really, they don't want you to buy the building doing 5% to just do some spruce up and then turn around, fix and flip and sell it. They want this to be a real, you're really doing some work on the building. And like the other one, a single line can be used for multiple contracts. The final sale must be an arm's length transaction. And then by arm's length, we really mean it's not supposed to be like a relative, not supposed to be your own company. It's supposed to be somebody who's different from you, different from your company. For the builders, the non-eligible things are: you're not allowed to purchase vacant ground for future development. They don't want you to operate or hold rental property. And they don't want you to refi existing debt with that money. So anyway, and some of these are for some of the other ones too, but they'll be explicit. I mean, they'll, if you're going to use one of these, you want to read the, have the banker get the SOP, or you can probably, I think you can access that yourself. But anyway, the standard operating procedure, and really read about all the absolutes on this, what you can use it for and what you're not. Usually it's the bank though, because the bank applies for it and they get the guarantee, and the bank, if the bank gets the guarantee, you're in. I mean, you get the loan if the SBA approves it. So that's what you want to do, is get the bank to to definitely put your best foot forward and get that loan for you. The number 4 is the working cap line. The working cap line, I had a project I did, and I'll tell you at the end of this. I hope I remember, but no, I meant remember at the end. So anyway, the working capital or working cap line is used for accounts receivable and inventory. It basically must use an asset-based formula. And SBA does this a little different than banks, but they come out with kind of the same bit. The bank will finance a percentage of eligible accounts receivable, and sometimes and I'm not sure if they really do a percentage of inventory, but usually it's done that way too. Eligible is the accounts receivable that have aged up to 90 days. So if you do some work, and the guy says, hey, I want 30 to 60 days to pay it, and you say sure, then that would be part of your account, your aged accounts receivable. And SBA will give that line for the working cap line to a percentage of that account receivable up to 90 days. So usually the percentage will really depend on who it is and everything over 50%. But I think since the SBA is guaranteeing the bank, so I think they're pretty lax on that. All cap lines, the max loan is $5 million, kind of like a lot of SBA loans, 7A loan, 504 loan. All of them have a $5 million max. And affiliates are treated as one single business. So the business and the affiliates are treated as one business for size and for other things. So anyway, the maximum guarantee is 75% of that $5 million. So the SBA is going to guarantee the bank the $3.7 million, which would be 75% of the $5 million. I did want to tell you about that one thing with the working cap line. It happened with, I had a company, a bank had asked me to go ahead and do, to get him a line of credit through the SBA through this working cap line. We went ahead and we looked at it in the SOP, the standard operating procedure, and basically it said this was only used for companies that were 12 months or more, have been in business for 12 months or more. But there was a caveat under that said if the business was well versed in this type of financing, and if the business had used it before, and if the bank was comfortable with that company getting this type of working cap line, that you could actually do it. And I looked at that as my hook on doing it, and I said, I think we can do this. He'd only been in business for like 6 months, 9 months. He hadn't been in business for a full year. So anyway, we went ahead and did that, and then SBA turned it down, believe it or not. So they turned it down, and they used the reasoning he wasn't in business for 12 months or more. I came back and argued the point and told them the SOP says this, and they said, we really don't care. We're not going to do it for somebody that's been in business less than 12 months. So sometimes the way they interpret things is a little different than you or me would interpret them. So anyway, they turned it down. We couldn't get them to approve it. And then the small business, when I do a consulting project, I'll usually, and if we're working with a bank, I'll usually do the packaging and I'll do the structure and everything and all the write-up for the SBA loan. So anyway, I'll charge him, I don't know, it kind of depends. I think with him, I think I'd probably charge him like $500 or something to do the whole thing. And so he sued me for half of it. And I was kind of surprised he sued me for half, because I'm like, wouldn't you sue the guy for the whole thing, And I always tell everybody that I don't guarantee these because I can't interpret for SBA. So anyway, he did. I could have went to the small claims court and won that judgment. But I was kind of thinking of the bank, and I thought, I hope he's, it's his customer. So I thought, well, I kind of want to make him happy, and I kind of I don't want the guy to say nasty things to the bank about me. So I went ahead and just said, okay, what do I got to do? Yeah, I'll pay it. Our court sent me a letter saying pay this amount. I paid that, and we were done. But anyway, it's kind of one of my worst experiences with a working cap line. Now the SBA has a maximum guarantee percentage. Usually it's 75%. If it's loans over 150,000, it is 75%. Loans under 150, it's 85%. During certain periods, certain recessions, and certain, with the pandemic and everything, they have done a higher guarantee, but it's usually for a limited time. Interest rates, the normal interest rates, most banks are going to do these for 50,000 or more, and the interest rate is basically going to be, if it's less than 7 years, it's going to be 2.25% plus prime. If it's over 7 years or equal to 7 years, it's going to be 2.75 plus prime. And that 2.75 plus prime is really what they normally charge for like their 7A loans and everything. And then from, and I'll give you the other two, from 25,000 or less, I've hardly ever seen a bank do an SBA loan for that little, 25,000 or less. But anyway, if the maturity is under 7 years, the rate is 4.25% plus prime. And if the maturity is equal to or greater than 7 years, then the rate is 4.75% plus prime. And the reason it's higher is they want to give the bank an incentive to do smaller loans. But I don't think 25,000 or less, I kind of doubt they'll do them. The second one is I gave you the rate for 50,000 plus, the 25,000 to 50,000. With a maturity with less than 7 years, it'd be 3.25 plus prime, and a maturity of equal to or greater than 7 years would be 3.75% plus prime. And if you notice, both of those rates for the lesser amounts are higher than the rate for the 50,000 or more, rate. So anyway, most of these will be variable loans, and they'll be based on a base rate. Now, usually the base rate is prime. I would say 95% of all the banks that do SBA loans are going to use prime as their base rate. There is a couple other ones, but banks really don't use them. So anyway, it is a variable rate, so you're not going to get a fixed rate with this, and that's kind of typical. So anyway, and these are as close as SBA will get to a line of credit. Banks do lines of credit, and when banks do regular lines of credit, it really depends on how good the collateral is. If you've got cash in the bank, oh, they'll do it. But what's funny is they still won't do 100% of cash in the bank. And the reasoning is they only do like 95 or 90, and because they're thinking if you don't pay, then they have fees and all this stuff that will be charged if you don't pay, and those will be added to that amount. So they want that collateral to be just a little over what the loan is. But anyway, that's the end of this video. If you like content like this, I'll be putting out about 2 videos a week, and hit the subscribe button, and if you hit the notification bell, you'll get to see all the new videos as they come out. And thank you very much, and I will see you in the next video.